TFIF traders, it's Friday, the end of the week, and these weeks seem to be flying by at the moment. Don't know about you guys and girls. Morning, Kay.
Hey, good morning, mate.
Is it me?
You're sounding a tad muffled. It's perhaps my speakers, but compared to prior days, it's not as clear. Did you change microphone?
Okay, hang on. Let me. How's that? Better?
Yeah, but now you're far away.
Far away?
Yeah, you're very, very far away. We can hardly hear you now.
How about that?
Yeah, go on, mate.
Yeah, is that better or worse?
Yeah, it's much better, much better. Go on.
Okay, we'll crack on. Yeah, I was saying, is it me or these days flying by?
They are flying. Absolutely flying.
We're getting older. It's that 50. You turn 50 and you just accelerate down the hill the other side.
Yeah, that's why I just celebrated my last birthday, right? I don't want to change yet another big figure.
No, we love a big figure. Hopefully we'll see some big figures today, a bit like we did yesterday. Right, well, let's kick off with our old mates in Japan, and we had some data out overnight, more CPI data, Tokyo numbers coming in much above expectations and the prior month, 4.3% for the core there, versus 4.2 expected for prior. Headline CPI for Tokyo, 4.4% from 4% prior. So no let up in inflation there in the country's biggest city. Very good numbers. That's going to play into the main numbers that we've been seeing as well. Not really a big move in the end, as it happens though, on those numbers. The market pretty happy with where it's at the moment. Do you think that's a bit significant, mate? We're not seeing any big moves on these sorts of numbers at the moment.
Yeah, well, I think first of all, it was a bit expected because Tokyo being, of course, the capital is likely where you are going to see food prices and things perhaps go a bit faster than on the countryside or in lesser cities. We did get 50-60 points out of it as it came out. Bit of speculation again on the Bank of Japan. Also, Bank of Japan had to go to work to defend the 50 BPs mark again on the 10-year JGBs, buying a little bit more of what they already owned, all of it.
Yeah, and they did their special funding thing as well. I saw overnight too.
Yeah, they are now using that as well a bit more often. So it does show their resolve to keep things in check right now, which is likely to have tempered the move somewhat. If we can go straight away to Kishida, who came out a little bit later. And that may have caused the market to think a little bit as well, saying that the inflation is much higher, but it's due to external factors, and he's not ruling out deflation again after this inflation round. And so there's two things to say about that. Is that first of all, this is he's no other than other typical Japanese prime ministers after all, because they were used to say these kind of things too, even though they were always fighting it and trying to get the inflation running. And then secondly, is it a gentle hint, perhaps, and I don't want to read too much into it, but is it perhaps a gentle hint that he's not going to nominate a big changer in the Bank of Japan as a Bank of Japan governor after Kuroda? So it raises half an eyebrow, I would say, the comment with me. So I don't know. Are we getting a hint here that it may be Amamiya after all?
Yeah, I don't know. I mean, yeah, he commented that they can't rule out a return to deflation. But it's, as you say, it's been ingrained there for so long. It's probably a matter of fact that they can't rule it out. I don't think that he's been talking very bullishly, on getting wages up, on fighting inflation. So I think that's, he's leaning that way. He probably sees deflation as a low risk at the moment, in my opinion. But I mean, he also said that the BOJ's December tweak to YCC was to enhance and sustain monetary easing effects. And so he's also playing the line, and it wasn't a monetary policy change. So
but if you would be planning, well, of course, again, they're Japanese, so it's a bit of a strange way of thinking at times, at best of times. If we think about it, he could have been more vocal about a possible change coming, but now he's apparently in text wording, at least, leaning more towards what's been happening, we just have to continue. And we are going to have to take everything into account once the nomination comes for the new Bank of Japan governor, because last week or the week before, when we had the Bank of Japan minutes or so, there was already a bit of a comment afterwards to say like, oh, be careful with larger changes, because it's going to put the Japanese government funding into jeopardy. And I mean, it's just one little box in a big bowl of boxes getting ticked here and there. But I don't know whether we have to read. And as I say, I don't want to read too much in it, because otherwise we would be short yet again, and perhaps that's a bit of a dangerous thing to do right now. But anyway, it's something that to keep in the back of our mind when the nominations will be done for the Bank of Japan governor.
And speaking of trading those expectations, the Amundi fund apparently is throwing in the towel on short Japanese bonds. Their head of Alpha Euro fixed income said shorting of securities has become ever more complicated to maintain. And it's probably easier to play the Japanese currency. Shorting government bonds is a different game now. Now, that's quite interesting. Obviously, we're not hearing what they're doing now. That probably means they're already out and already into JPY. But the Amundi fund is one of Europe's largest, if not the largest in Europe. Nearly 2 trillion in assets on board. So these guys aren't small fry. And if they're starting to play out of, shorting bonds, and they might have been one of the big players in that trade, constantly pushing and snapping at the heels of the Bank of Japan and its YCC, if they're shifting, that could cause another shift from other players who then think, oh, these guys are out, we're getting out too. And a shift into the yen, which could then further see more flows coming in there and more speculative trades on that side. It's all yen related, so it doesn't necessarily mean that there's going to be flows in and out of yen. Thus, we see yen moves, because obviously, if you're short yen bonds and you're buying them back, and so you got your money in yen anyway. But is that a potential big shift in terms of players pushing against the YCC?
I think the interesting bit of that in this article, and I've read it as well. And by the way, you're right. Amundi's biggest European asset manager, and it's in the top 10 globally worldwide. So they when they speak, we should be listening at least or hearing at least what they say. The interesting bit in that article as well was that they said that even if they would abandon YCC, but looking at how the interest rates are right now, and they don't expect like major shifts there, and they'd say that they would expect the US 10-year yield and the Japanese 10-year yield to go not much higher than 0.6, 0.8 range, or maximum 1%. So they're not looking at any moves which would be comparable to anything which is going on outside US, UK, and all the rest of the countries. So that's an interesting little bit in that article. But the fact that they are giving up, yeah, they probably made a lot of money. So, but yeah, then keeping the yen is a bit of a strange one. You're long unless you think that the rest of the central banks are done and dusted, and we are going to see those currencies weaken a little bit.
Yeah, definitely. And I think that's a point we always need to consider when we're talking about the Bank of Japan tightening. Unless there's a real huge inflation shock over there, we're not going to be seeing them racking up 50 pip hikes and 75 pip hikes and getting rates to 5% anywhere close. Then at the moment they'll be lucky to get them just above zero over the next probably over the next 2 years. So don't be thinking that we're heading the same way as a lot of the other central banks into massively positive rates. That's probably not going to happen at all. But conversely, if Japan gets interest rates to 0.5%, that's like the US getting them to 5% in comparison. So it's smaller margins, but still we may see the bigger moves or the same big moves in assets, bonds, currencies, or whatever.
Yeah.
But it's just a different level that we're talking about when looking at the Bank of Japan and all things Japan.
Especially when you talk about the Japanese whales being the biggest holders of US debt, for instance, externally. So if they decide to move and to repatriate a bit more home or whatever, it can create a big shift in currency markets.
Yeah, exactly. Over to Australia and some PPI data there. Now, Q4 data for PPI, surprisingly, not matching what we saw in the CPI the other day, actually pulling back, missing expectations, lower than expectations, 5.8% year on year, down from 6.4 prior. Quarter on quarter, still a positive, but not as much as expected. So maybe that CPI report had some skew in it, maybe some short-term inflationary impacts there for the quarter, because PPI isn't flagging the same. So something we perhaps need to keep an eye on, particularly in the monthly CPI reports that Australia now release now. Import and export prices up on the imports, but lower than last month, and the export price is down a tiny bit as well. So as I say, a bit of a skew there in the numbers that we're seeing now. UK had some data out, and from the CBI yesterday, and what that shows is it's a retailing number, a wholesale retailing number, and it came in a real massively negative -23. Now this number is one of these that's always very pessimistic, but it doesn't bode well for January retail sales. Much like other countries, the UK hasn't seen a good November and December. Once you strip out inflation and everything like that, we're buying the same, but it's costing more. So this doesn't look like it's going to improve anytime soon, and this is something that we're going to need to watch from around the globe, how the consumer is going to do in the early part of this year, because that's going to be a big player into what central banks do. We can look at data like the PMIs, manufacturing services and the like, but the consumer is going to be a big watch for central banks, and we need to keep an eye on that. Now, let's go over the US data, because there was quite a slate yesterday, and it was a bit of a funny reaction in the market, really. So first off, the big number, GDP in the US. So it came in higher than expected at 2.9%. Let's make sure I've got it all up there on the screen. So here, it came in high at 2.9%. So that caught the market a little bit by surprise. And initially we saw the dollar just making a little bit of a move up. But then we got stuck into the details, and some of the other details weren't as hot. Sales, not as hot. Consumer spending, not as hot. And so there's, again, that consumer side not looking as good as what it could be, and signaling some problems potentially there. So from that, we looked over and we got the jobless claims, and decent numbers coming in there. 186k. I'm just trying to find it on the thing. Where is it? There we go. 197k on the 4-week average. 186k, the headline number there. So another downward move in jobless claims. So on the jobs front, that looks fine as well. But we don't know if this number is being affected by some of the New Year effect, people coming back from holidays, that sort of thing, or indeed this weather situation, which we've been speaking about for a couple of weeks now, because it potentially, for the jobs market, can throw a bit of a curveball into the NFP. People may look at that and say, oh, jobless claims, great, it's coming down again. So the employment market is strong. Well, if the claims are coming down because people couldn't get in to file a claim because of the weather, that potentially indicates that NFP might be affected the same way, and thus we see a more negative number because people couldn't file and the reporting period couldn't be done sufficiently. So it's not just a thing to say the initial jobless claims looks very good if there's things affecting it, and the same thing might happen in NFP. I still think there's a risk. It might not happen at all. We won't know until next week when we get the NFP, but keep this in the back of your mind. If we see a big outlier number, a minus 80 and a minus 100k or anything that looks shocking, there's likely to be some effect behind that, possible weather effect behind that, which means if the market finds that out, you're going to get a sell-off in the dollar on the initial reaction, and then it's going to spring back if all the prepared heads start throwing out the weather excuse. So it's going to be a big one next week. But overall for the market, as I say, the GDP came out, what should we look at? Let's look at Aussie dollar. That was a good example yesterday. The GDP came out. Initially, the dollar dipped a little bit. Then initially the dollar jumped a little bit. Then the market caught the other way, and we saw the dollar get sold off quite significantly. We tried to get up back up towards the highs in Aussie dollar, managed to go through the highs in the Aussie dollar, and then there was a complete turnaround. That was the part that really caught me off guard. I thought we were going to be making a break up, and we were going to be off to the races. What do you reckon caused that flip around again, Kay? Was it some parts of the market looking at the headline number first, buying the dollar, then looking at the components, selling the dollar, then thinking a bit later on, well, it is all really soft landing numbers. Let's buy the dollar again.
Yeah, and it's those. Well, there's several things that are going on right now, and not in the least month end. And then we saw this jump on the equities as well. So the correlation funds would have been selling dollars as well. I think. We are also ahead of big levels in the euro dollar, in the cable, in the Aussie dollar, and the market is probably already thinking about what's going to happen next week on the central banks as well. So I'm not sure whether there's a lot of people involved in those up and down moves, but what we do have to notice is that we keep on coming back to let's say the lows of the dollar, or roughly around there. When the dollar jumps, it can hardly hold its levels, right? If you look at the euro dollar, had those dips back down to first of all low 107s, then low 108s, and we're still hanging around 109, close to 109. Cable a bit same thing. We've all been saying cable had nothing to do at 124. It should be trading 121, 122. Well, no, it's still hanging around 124, and the dollar yen as well. Trouble to keep the 130 line for more than a few hours as well for now. So I think there's we're in a range, but we are at the, let's say, bottom end of the range of the latest dollar, and because the market thinks we're close to a pivot or close to a halt, a pause in the Fed rates as well, and then we, as you were already mentioning, and we've already been mentioning, we are ahead of a bumper week with the combination of not only the FOMC but the ECB, the Bank of England, the US jobs report. Perhaps the market is just not willing to take much on right here and now, and just they're still in a sell the dollar rally bias. So, but without going full steam into it, And I think that's what we are seeing now in the different markets. I see more interesting moves on some crosses, for instance, than I'm seeing on the dollar right here and now. But we have to acknowledge that the dollar is trading at the bottom, at or around the bottom end of its latest range, and I mean latest couple of months, right? Yeah,
exactly. It's not. I think this is perfectly a pause before the big week next week of central banks. Can they be the kicker that moves us further out of the ranges? Can we see euro dollar breaking 109? Significantly getting above that 109.40 cable. Can it build upon a break of 124? Aussie dollar, can it do more? Always we're asking a question in the Forex markets, but so far over the data, there's, as I expected, there has been plenty of volatility because we're getting decent variations in the numbers. It's given us some moves to get in and jump on, and it's all about, can we break the ranges? And if we can't break the ranges on a piece of data, like yesterday, we couldn't break the highs in euro dollar after that initial high. We got up to the 20s again. Same thing for Aussie dollar. We got up there, we made a new high but couldn't hold it, and now we're back below and holding the old levels yet again afterwards. So if you get these data moves and we're testing these good levels and they're holding, there's your trade, because what's happening is the market's moving and it's coming right back to where it started from and then going sideways from there, because, as Kay says, no one wants to push the boat out ahead of next week. No one wants to take the Aussie up to 72 and find out that that the Fed is super hawkish next week. So the market gets itself into a position where, right, I'm happy with what I got. I don't want to take any more on, but I still might trade around the ranges. And it gets the levels that are juicy enough to hit, I'm going to hit them. And if they're doing that, then that's what we should be doing as well. But Kay's mentioned some of the crosses, and we'll take a look at those. One last piece of data just want to look at. Again, it came in very strong. Durable goods up 5.6%. Not often we get a number as big as that. And as soon as it came out, I thought to myself, there's something going on in there, because it does contain what's called big ticket items. So aircraft orders, that sort of thing. Those are huge swingers for durable goods, and that's in effect what was in there. Non-defense aircraft new orders was up 115%. That was all to do with I think it was the Boeing orders that went through in that month.
Yep.
So as soon as I see this number, I think, oh yeah, great, that's a good looking number, but what's behind it? And when you look at what's behind it, okay, maybe it's not such a good number. And when you look at core durable goods, so that's more the consumer side, down 0.1%. Not as bad as expected, but still a negative. So on the consumer side, again, a bit softer. So this is why we look at the data a lot, because you've got to pick through some of these numbers, like those 5.6%, to see what is actually happening. Great on the big business side, not so good on the consumer side. Right, so let's have a quick look around. As I mentioned, in the Aussie dollar, in this range, as long as it holds up above this area here, 70.65, we're sitting pretty. We're trying to hold up above 71, 70.90. That's going to be another positive. We can close there for the week. That will look good going into next week. Ultimately, want to see this area broken. If we can't break this area, I think the clock is ticking on this, and we're going to get a similar move to what we saw here, where we tried, to get above 70 level, tried and failed, had a little go, and then wallop. Couldn't sustain the break, and we saw a decent pullback. I think we might be setting up for similar here. If we can't get above this level over the next few sessions, I think we're going to see a steeper pullback, maybe down to the 70 area. If it maintains what we've been seeing previously, higher lows, then it keeps the rally in play. But I think if we get under 70, then perhaps we're looking at something a bit different, and maybe even a sharper pullback. So if you're long in this one like I am, keep an eye on the clock. The more hours that pass under with us not breaking here, the more likely we see a pullback much steeper than the levels we've already seen. Now I've got to tip my cap to Kay and the other guys in the room who, pretty much we all nailed the top in this one over the BOC. And that proved to be, the perfect stretch point trade that I've been talking about all week. I'm still short this one. Last knockoff just down into 145. Looking to see if we get a bit of a break under this level. If we hold under 145, which we're not doing at the moment, then we should get a move lower, at least down to maybe the 142.5, 144 area. But I'm going to pass it on to K-Man because he's Mr. Crosses. He's probably got a bit more tech in there. Kay, if you want to have a little look around?
Yeah. Right. First of all, perhaps keep your screen. So first of all, we are getting the core PCE and the PCE this afternoon, and then the final Michigan, which saw a jump last time. Yeah, on the first readings. So what do you make of the PCE? Because I must say that it's one of the base IDs, prices coming off, less inflation, whatever, yada yada, that people are looking at for the FOMC to stop. But do you think they're a real mover today?
It's funny because last year everyone was looking at the PCE before the CPI, even though the CPI always comes out first, and PCE was more important. Now the market doesn't care; it's jumping all over, making the move on the CPI. So in theory, this is just a confirmation number for now. If it does the same thing, or shows us carries on showing the same trend that the CPI is doing, I don't think it's going to move a lot unless there is a big variation in it. Conversely, if we do see it going the other way to CPI, that potentially is going to throw the cat amongst the pigeons. So if, for example, core CPI comes in unchanged or something like that, where we've seen it lower in the CPI numbers, that's going to throw a spanner in the works, I think, and then maybe we're going to get a big move. But if it comes in on or around expected, maybe even a bit softer, it's just going to confirm what we've been seeing from the CPI. The algos and the news bots might react to it, but if they do significantly, I expect the price to come back to where it began before that. What I would say is keep an eye on the spending and income numbers. They might start to become more important because, again, as mentioned, looking at the consumer, how is the consumer faring? Are they starting to see incomes drop due to high inflation? Is spending going down? Those are probably the bigger flags we need to look for in the data. And the Michigan, as we all know, obviously the headline number is going to be important, but those inflation expectations are going to be what the Fed are going to pay attention to. So yeah, that's my thought on what data is going to be important today. What do you make of it as well, Kay?
Well, I'm a bit in your camp. I think that even though we know the Fed is looking at those core PCE prices, right? I don't see it as a big mover today ahead of the bumper week we are going to have next week. So unless, again, the market is in this state of mind where it wants to see weaker numbers. So and that's probably where some of the players, or at least the algos, will put their teeth in if the number comes really out badly, or lower. Let's say lower, not really badly, but lower. Because we are just in that kind of mood in the market still, right? The market desperately wants to be right on the FOMC pivot, and so that's going to be likely. We are going to see some results or some outcome for that next week on the combination FOMC labor report.
Yeah, and I think that was also behind the move, some of the moves we saw after the data yesterday. Sometimes the market has a big risk event, things like big data. So, we know the trend for the dollar is lower. Sometimes the market will pause ahead of the big risk events to see what those numbers are, to see if they're going to be a game changer or not. And so you get these tops and highs in things like Aussie dollar, euro, cable, but it doesn't necessarily mean the market's done and dusted. They get through the data, they assess it, they think, right, is it good? Is it bad? Does it change anything? And if it doesn't change anything, then they continue plowing into shorts. And that's probably one of the reasons why we saw the dollar get sold off and some of these highs, tested, because their market wanted to get over the data to carry on what it's doing. And the same could happen today, and the same could happen over the FOMC. Does the FOMC change the market's view? If not, it's going to carry on doing what it's going to be doing. Go on, Kate, I'll let you have it. While you're taking the screens, Brian's asked, any advice on transitioning from being a US trader to start learning to trade the crosses?
Yeah, we can talk about it. But
we can talk about that. Yeah,
that might be a subject for a whole flow show.
Yeah, I'll pencil that down.
Yeah,
trading crosses, because it is something we've been speaking about at the beginning of this year.
There's a lot to talk about it, and it's not really making a transition, but there's a lot to talk about it if we really want to be trading crosses a lot. Yeah. Okay, you guys see my screen?
Yeah, all good, mate.
So this is the euro, that famous euro, that euro cat that a lot of us in the room are watching. As we can see, and it's going back to 2021, the importance of this level. It stopped on it and then did this last leg higher before the big move lower when the central bank started to change, the ECB slow, Bank of Canada and the FOMC being much more vocal and hiking rates faster. I recall at that time, Bank of Canada was really one of the leading central banks to start raising rates, but then again we retested this 146 and a bit, and then again we retested it to 146, 30, 40, and then we did it again 3 times over the past week, and again this level is really solid as a rock right now. So 2 things. You have an idea about what you want to do, or just technically you nearly have to play it. I'd say if you don't play such a level, I don't know what kind of text you really want to see to play. But even on a more fundamental basis, we know that ECB is on a hiking path. So I think that's part of those big jumps that we see. But the Bank of Canada is still, although pausing, not completely giving up, and also the data in Canada are not really crapping out. They might do later on, but they're not really yet crapping out. So for various reasons, I've decided to get into it again, and the beauty of this one is that your stop loss is clear, even though it makes a false break and then it comes back lower. That's the risks of those are the risks of trading, but your stop loss should really be just above, whether you are at 20 points or 30 points. It's Euro Canada as well, right? So it can go a bit fast. My stop is going to be somewhere above 146.5. I don't want to be in there. I don't think I will reverse the trade, but at least if it starts to break, you don't want to be short anymore because of the importance of the level, right? So that is the clear one. Now, on the corrections, it could still be only a correction, but on the moves lower, we are stopping a little bit in the low 145s here, just ahead of the 38.2 at 144.85. I'll be looking at that. And yeah, another reason as well is that month-end flows. We are in month-end today. We're trading value date month-end, by the way. So there may be some interest from the US corporate side. Who knows? To do a bit of dollar shopping. I'll come to that in a minute when I'll look at some of the dollar pairs. But we can't rule it out. But also, if we look at the performance that the European stock markets have been put on, if you are a FX neutral fund, the chances are that you may need to sell a few euro crosses into month end, and that will be music for Monday and Tuesday, I think. So a couple of things got me back into the position. Also, what people noted in the room as well, a few of us around 145.5, we have this trend line broken. And we'll likely, a few of us, going to try to lean against that as well. Targets, it's always difficult to say. We'll see where we end the month for a starter, and then I'll likely square it up if we get the decent move down. Call it really, if we do the full 100% down to 142, no hesitation, but it could already stop around where is that, 143.90 figure or so, and then I've got a bit more in the 143s here. But those are the sort of moves I would be looking at to if I get those into the month end. I don't think I want to be short any euro crosses into the ECB, because I still think we've got ECB on a bit more hawkish path than the rest of the central banks now. So this for the Euro Canada, pretty nice setup we've been watching for a while. Now, and then I just spotted this on the dollar Canada. Actually, we've had these several tries to blip higher, but these last couple of days we are again respecting this trend line, and we are forming a little bit of a descending channel, slightly descending channel here. So keep an eye on what's happening around 133, the figure, I'd say. It's also, if you look at it, we are around those prior lows as well. If we get a break, there may be an acceleration down to 132.25. Okay, Brian, yeah, all right. Thanks for the MA as well. So that for the Canadian dollar. Then have a look at the cable. We were saying we are at pretty important levels in the cable as well, and we can see that here. Hang on, yeah, we had already this is the last top, actually was around 124 before we went down all the way to 103, and then now we are back, and then we already put in that top on mid-December, 2 tries. We had a third one, actually a fourth one here, and then a third one here on Monday, and then overnight yesterday again we did a move above 124, and it's running out of puff right now. If that goes, I'm trying to respect that level as well. If that goes, then we may see a higher move in the cable back into the 125s likely. A bit similar, I was talking about the month end. If ever we see some dollar demand, we may see this cable trade back down to somewhere around here, perhaps even a bit lower. I'd say keep an eye on what's happening at 123, the figure, if ever we see this US corporate dollar demand coming in this afternoon. Again, it's not a 100% mathematical thing, but we have seen in the past that value dates, month-end value dates, have seen some dollar demand. So just keep that in mind, and we can lean against a pretty cool top formation there as well in the cable. So that for the cable today. Well, euro dollar, nothing's changing. We're still wrestling with the magic zone 109, 109.40, but we're not moving too far away from it. So I'd argue that any setbacks that we see back into 107, 70, 80 ahead of the FOMC are probably going to find buyers and who are willing to trade the range if they sold against this 109 figure 40 zone. If it breaks 109.40, I think that but after the central banks, okay, if it breaks this 109.40, it's going to run pretty fast, in my opinion. But for the time being, we have to respect it. What else? Euro sterling. Euro sterling is in a yo-yo. Again, based on what the equity markets were doing and the difference between what the European markets have been doing and the UK markets, I would not exclude next Monday or Tuesday that we are perhaps slipping a little bit lower again into month end. If that would be the case, and I've already been talking about it in one of our rooms, I'm going to be looking at buying topside, because I think that ECB will overpower Bank of England, and I am small long on the cross already in cash, but as everybody knows, I'm trading those things around quite actively. So for the time being, I don't have a big position in there. I'll be looking to buy a few more into lower levels for as long as the magic zone 86, 85 figure holds. And if I get a lower one, instead of having cash, I might add a few topside options into ECB, Bank of England. What else? Oh, it's really this silver is really respecting this trend line. I don't know how many times we have to try, but again, well, it's coming a little lower, so around 24.35 now, which is around 24.30 yesterday's high. But again, same as other dollar pairs, okay, the volatility here is higher, and it's a daily chart, yeah. But if you look at even on a daily chart, despite the volatility, we still continue to hang not too far from the level. We are not starting to go back into lower levels for now. So I'd say that anywhere around those low 22s, it's probably where I'm going to add a little bit to my small long-term positions right now, for perhaps an attempt to break it, providing we're getting a soft landing. A soft landing is what this one needs. If we really get a soft landing globally, and this should sooner or later power on. Gold, I don't have anything, but yeah, we're trying to break down. But to me, the levels are really 1897, 1900, and topside it's 1950, and then we're talking about the 1970s. I'm quite uninterested in trading this right here and now, because I think it's moved more by perhaps Russia, China than really fundamentals in this case. Quick look at dollar mix. Still, it's respecting this line, and if ever we get some weakness out of the FOMC, this could put in another dip lower. If in turn the FOMC turns hawkish, watch out if it breaks above 1890, 92, then we could see a move back above 1900. For the time being, I'm staying out. Banxico is having a little bit, speaking with a little bit of a split tongue right here and now, and I don't like their comments about decoupling from the FOMC, about the Fed, which would mean that they could just stop hiking. On the other side, it's still a 10% currency, so stuff like this, I think I would still be looking to perhaps sell a decent rally, but I need to see what happens over the ECB. And for today, that may be it, Ryan.
Yeah, thank you very much, mate. I just want to take back to your first comment you were saying about Euro CAD, and how. Let me get my screen up. There we go.
I can. Oh, okay.
Yeah, and how, you know, there's times when you know, the text, they don't get any more perfect than you need them, and if you're not trading stuff like that, then, you know, I asked the question, why are you trading? if you're not trading big levels. And something like Euro CAD and what's happening now is the perfect storm for you. And those of you who've been on the show from the start will know that we were playing this one down here back last year. You know, this big solid level, monthly levels. It was lasting, bouncing off that support, and probably about 6 weeks, maybe 2 months. We were sitting, all of us, with sell stops in this one in case it broke, and playing the other side, and we all got a storm. And I think you got it. You ran yours nearly all the way down to the lows. I think I was out a bit before you. I was getting out around here, and then I got done on the trailer. But you selling it pretty much down to the lows here.
Yeah, I think I was somewhere low 129. So.
And this, you know, we have the discussion. You know, some people talk about they're only a tech trader, and that's because maybe they don't understand the fundamentals and whatever. But there's times when the price does this, and it does this up here, and you've almost got to trade it. You're failing yourself if you don't trade it. Doesn't mean you have to throw your house at it and get all excited and exuberant over it. You trade it like you would and manage it like you would any other trade, but it's clearly defined. You know where you're wrong. You know where we knew we were wrong if we were buying off this level and trying to trade the bounces. We knew if we were wrong down here below this level. Same as up here. You know, as Kay said, I've got my stop. I did have my stop. I got in at 146.27. I had my stop at 55. You know, 28 pips risk for that, for a move that's over 100 pips now. You know, sometimes trading, it doesn't often give you things as clean as this. When it does, you've got to get on it. And I didn't get on this move or this move. The other guys were. You know, I'm only in this trade because of the analysis that Kay's been doing over the days and weeks, and the other guys in the room. And I was trading. I wanted to trade the BOC. You know, we set it up. I was looking at dollar CAD. I had my levels in that, but it didn't happen. So I turned to this one, and boom, dollar CAD. BOC couldn't break that area. There's times when trades are a no-brainer. And so if you want to trade, if you want to make money, you need to look at this sort of stuff. It doesn't matter if you don't know what the Euro CAD cross does in its entirety. You don't know the fundamentals behind it. It doesn't matter. At certain times, people say trade the levels. Well, there's a level. Go bloody trade it. You know, don't let up. So anyway, that's my lesson for you guys. You guys need to do some homework over that. You know, but then on the flip side, I would say, you know, don't just trade it again when it gets up here. You have to take each move on its merits alone. So if we do get a move back up to this level, it's not it's maybe not a no-brainer. Shut your eyes and sell it, because you want to know why have we moved from down here back up there. But if you like the reasons, if you add them together and think, right, okay, yeah, we've come up such and such, I think there's still a good chance it's going to hold. Fine, you've still got a low risk trade. And if it doesn't hold, well, this time you've missed it.
So Ram, I don't really understand the question. You may not trade counter trend, so EuroCAD could be out even at this level. Do you understand the question? No, I
don't know if you can clarify that a bit, Sarah, what you mean by that. Yeah, I mean,
but anyway, I mean, as usual, what I'm doing in my trades, and the people in the rooms know that, and I've been saying it here already a lot of times. I enter trades, and then I start to manage it around, just to manage the risk as well. So, for instance, if this would now start to fly and go back above, yeah, I'm going to give back something, but I've been trading it around already. So and the re-entries will be higher than where I cover the take profits, but I've actually re-entered a tiny one today because I went flat yesterday, but we're trading below yesterday's levels, and I think that we might see, as I was saying, we might see the euro crosses perhaps a tad lower for the month end. So I will still want to have some, but yeah, the thing is, if you trade those, the way I'm trading is if it goes now through 146.40 or 50. I'm not going to lose any money. it's above moving average in an uptrend. It's a reversal trade against the trend. Well, I mean, it depends how you look at moving averages. And yes, if you look at this technically, it's a counter trend trade, but it's also a trade based on 4 or 5 different tops. And so I think it's absolutely worth it. And then we're looking at a few other things as well. Yeah, okay. I mean, I'm not a big fan of those MA trends and whatever that develop, but yeah, I see what you mean now.
Yeah, I get your idea. It is a bit, it is in an uptrend. It is on paper a counter trend trade, but for me, that's not my basis behind the trade. I'm not saying, okay, this has gone up so far, I'm going to counter trade it. I don't care about this trend, what sort of trend we're in, too much. This trade is all about this line, one number up here, 146.40, let's call it one number, okay? That's trading. You get one number, doesn't matter where it is, it's either going to go above it or it's not, or it's either going to go below it or it's not. That is trading in its simplest form. You have a level, the price action is showing you it's not going through that level. Trade the level. It's it. I don't care about all this. For this particular trade, I don't care what the trend was here. I don't care if it carries on up to 150. All I cared right this minute and right at that moment when I traded it was, what is this one number, this one line going to do? Is it going to break or is it going to hold? And this time it held, and you make money. So yes, this is what I'm just trying to explain. Yes, you can have all the fundamentals you like, all the trend analysis you like, moving averages, whatever you want to look at, RSI, whatever it is. But sometimes trading just boils down to whether a price can go above or below a single figure. And sometimes you get these perfect trading opportunities or moves where one line, it doesn't go to 150 and then come down, and it doesn't go to 146 and come down. Bang, it's literally one number. And you don't get that perfection a lot. But when you do, you've got to make the most of it, and you've got to recognize it. Anyway, that's the lesson. You have just trade the level. That's right. The edge. I hope I get your name right. Exactly. Just trade the level. Just trade level. Anyway, we shall maybe on Monday we'll look at the cross side of things. Just run through, why crosses are important again, and what's the benefits of trading them. Also, what the negatives are of looking at them.
I won't be around, Ryan. I won't be around on Monday, and I'd like to be there when.
Okay. Are you around Tuesday?
Last day of the month. Yeah, why not? We can look at the process.
Okay.
Maybe good on Tuesday, last day of the month. Yeah. Then we look at a few crosses, and then we look where they are and see what we can find as. Crosses are a lot. Okay, there's technicals, but there's a lot of correlations in it, and we can have a look at those as well.
Yeah. Okay. So some homework for me and K-Man to do then.
Yeah.
So what's up on our cross knowledge so that we can give you the information you need.
Yeah, lovely.
The end of another week, plenty to go today, obviously with the data. So please trade safe. As always, thank you very much for coming to the Flow Show.
Have a great weekend.
Have a great weekend, everybody. And thank you, Kay. And I shall say thank you to Stel behind the scenes for his input and taking the mickey out of me earlier this week. Please have a safe and peaceful weekend, and we shall see you all on Monday. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.